One of the most requested stocks for me to analyze has been Crocs. And how would it not be when the market capitalization is just 4 billion and the free cash flow is 800 million? That's a 20% free cash flow yield. Let's check and let's make an analysis whether that 20% yield is real value. If we look at the stock price, it boomed after the pandemic as everybody was at home wearing their Crocs. However, since then they have had significant ups and downs, and now they are at this downturn. What's going on with the stock? Well, has been declining for a little bit more than a year, and now we have to see whether there will be a rebound next or it will continue on the unfortunate past bankruptcy trend that this company has seen in the past. If we look a little bit at the numbers, the investment thesis, well, global leader in casual footwear, two iconic brands, and they are diversifying, expanding, and going beyond the extremely ugly shoes that are representing them. However, if we look at the numbers, the stock is down, but they still made 133 million in share repurchases, lowered debt, that's 230 million in the last quarter, that's huge cash flows, that's again the 20-25% free cash flow yield that we discussed at the beginning. Hey dude, their, let's say, ill acquisition that they made a while ago, but Crocs is still the key brand for their revenues. They are expanding internationally, and North America is declining, but not that significant when it comes to their market. Nevertheless, this is what really hit the company, and that's their guidance down around 10%, and perhaps even more importantly, their operating margin down to 18-19%. And now they say that the customer sentiment is chasing purchasing patterns and predicting trade wars and things like that. But I've been analyzing significant number of fashion businesses, and first and foremost, whatever fashion manager will never speak the truth. And the truth is that here and there, they are not understanding the cyclicality of fashion, and especially the cyclicality of consumer preferences, the fickleness of those preferences. So it's always easier to say the consumer this, the consumer that weak spending or whatever. There is no recession, spending is good, everything is good. It's the fashion that's changing. But okay, the fashion might be changing. If we look at their numbers, everything still looks very, very good, but Hey Dude is declining, so that is a stain on their shoe, I think, because they acquired it in December for 2.5 billion, 2 billion in cash and 450 million in Crocs shares. If we look at that acquisition, what's doing, it's still at 4 times revenues practically, so it's not something that they were likely planning, and that's also something that happens to fashion managers. So they decided to make their acquisition at peak Crocs boom when everybody was at home buying their Crocses. That acquisition, the market immediately thought it would be too bad, then it was okay, bad, okay, and here we are now still on that downward trend. But let's look a little bit at the numbers. Really a pandemic boom from stability and stableness and difficult situations, what was bankruptcy, really booming and now reaching 4 billion in revenues. You see very good gross margins, great gross margins, because they have this mold that makes producing cheaper than other competitors. So Nike has a lower gross margin, for example, which leads to also good operating margins and extremely high operating profits and cash flows. Then if we look at the numbers here, of course, they have impairments, which are not cash impairments, of 730 million. Add that to the net income, that's 260, that's 960. So 960 on the market cap of 4 billion, that's a P ratio, not of 3, Sven, but of 4. P ratio 4 compared to the market 30 is still something crazy. And you can see here the adjustments. This would be the earnings, all else adjusted for the impairments. Nevertheless, if we look at the balance sheet, the goodwill and the other intangibles are 1.7 billion. Compare it to the equity, so there is not real book value, but likely the value of the brand, especially given the cash flows from operations of 800-900 million per year, would be, I think, very attractive also to a private buyer, someone who can then squeeze and milk the cash cow out. We are already now at that part of margin of safety where somebody could and would take it private to milk it off at the right price. So perhaps the stock can go even down another 30% and then somebody would buy it. So we are already at those levels with 4 billion where someone might go crazy. One thing to consider when it comes to the risk and reward of investing here. Okay, they have been lowering their debt that they have used to acquire Hey Dude. That's always the issues with acquisitions. You acquire something, if it's not good, you are stuck with that debt. However, if we look at Google Trends, the trend has been going up and down, but I see that the trend is still positive across that cyclicality, but it's not like people are not buying this anymore. If we ask ChatGPT what is the reason for the stocks going down, of course, weak guidance and slowing demand that we discussed, tariffs also impacting the cost side of things, cautious consumer behavior. They say that they are super cautious, but we don't see yet in the economic numbers. And perhaps key is the shift in fashion trends. More is going to athleticism, things like that. The numbers, the front numbers, face value numbers, are hit by that acquisition and impairments. But we still have to wrap ourselves around the 800 million free cash flow, which is a 20% yield. If we look at others, if it looks cheap, the consumer discretionary sector is at high risk of performing badly. So let's discuss a little bit deeper the risk and reward, which is why you are here. Thanks for watching, like, subscribe if you haven't. Now, they still say that they have a lot of potential growth. They are growing 30% in China, so that's also something very interesting. If we look at the guidance before they cut the guidance, it was still for growth. Now they say for the next quarter minus 10%, which is significant, but let's look at the conference call and see what the CEO and others have to say about the company. Internationally, they are growing or losing at home, but stable at home and let's say growing internationally, so that should be positive because all these fashion brands usually when they reach success once in the States, even if it changes in the States, it still takes a lot of time to, let's say, lose that steam globally. That coolness sticks. China is growing 30% and North American business was down 6%. They repurchased still shares, so the cash flows were still positive in Q2. They have cut the outlook and lowered their margins. And perhaps the key is that their operating margin is now expected to be 18-19% and not 24%, which then really changes everything. Because if I cut the operating margin by 30%, minus 100 million in interest, minus taxes, other costs, we are immediately down to 500, maybe 400 million of free cash flows. Let's say 400 because they also have stock-based compensation, and that is just a 10% yield on the current price. So the market already adjusted for the situation. 10% for such a fashion business is pretty much the standard. 20% would be something, but the market just adjusted already for the quarterly guidance. When it comes to these conference calls, there is always the focus is on North America, but that's also something. When a fashion company loses in America but gains globally, I think it was also the case with Skechers that I have been following now for 5 years or did a few videos. Skechers was growing globally, North America, the stock was destroyed. Of course, now the story is much different. Same story with Crocs. If you are down in America, the analyst and the market kill you, because there is only America in the stock market and Wall Street. That's how it is. Perhaps an opportunity for those who are willing to think differently. Anyway, they are accusing the consumer that they are not purchasing, not even going to the stores, and we see traffic there. Well, the question is what they are purchasing. There was a good question about, are you losing share in the order book? And they say that the consumers are migrating back towards athletic because there is the LA Olympics in a couple of years. That's a big question mark. Maybe that's just likely consumers switching their preferences or getting bored with something, going into something else. It's a very, very competitive environment. If we just adjust their guided EBITDA or even perhaps a little bit weaker, then the debt to EBITDA is not as good as it looks now, goes to 2, does no buybacks, which is another thing that pushed the stock price higher. So when we adjust for the information, this is the result. 10% free cash flow yield, no buybacks, does not stock that easily up, because if you spend 100 million on a stock market capitalization of 4 billion, you're likely, given the inelastic market hypothesis, you're likely to push the stock up 500 million, that's 10-12% if you keep on spending like crazy. 300 million of buybacks per year that they have done, even more in the past, would push the stock higher. And then just a comment here on the athletics. If you look at Nike's revenues, it's down 12%, so it's not really athletics. Who knows? Anyway, no margin of safety. Somebody might take it over. Management might be wanting to sell it at some good premium, cash out, and that's it. They have been rewarding themselves with about 30-something million of stock-based compensation over the last few years. That's okay, but not tragic. And very interesting, I would say positive risk and reward, because the cash flows are very, very strong. They would need to lose much more not to have positive cash flows. So the brand, someone might take them over. So perhaps positive risk and reward at this moment. Maybe you can lose 30-40%, but you can gain 50, 60, 100 if the trend turns. However, when it comes to fashion, given the consumer, let's say, easiness to change trends, the extreme competition, fashion is simply not for me, so I will not be following it. I hope I gave you a good perspective just from looking at it, and then you can use the value to see whether it fits your portfolio or not. To see the things I follow, check my quadrant and my research platform. Thanks for watching. I'll see you in the next video.